It's Tuesday, April 9th. Welcome to MarketFoolery. I'm Chris Hill. Joining me in studio today from MFAM Funds, a proud graduate of the University of Virginia Law School, Bill Barker. Congratulations to your Cavaliers.
Thank you. Thank you very much. It was a good run.
Heck of a run. And we've got condolences to our colleague Micah Robinson, who's a Texas Tech grad, who was at the basketball game last night. But congrats to Matt Trogdon, our colleague, and the many UVA graduates who work here at Fool headquarters. A lot of orange and blue around the office today. A lot of people flying the colors, and why not? They should.
Yeah. I mean, this is a Virginia company.
That's true. That's true.
People don't know that.
And let's face it, when it comes to major college sports, you're probably going to have a better shot at winning a national title with your law school than your undergraduate alma mater.
Time will tell.
I guess we'll see. We're going to dip into the Fool mailbag. We've got news from the healthcare industry, the packaged foods industry. Let's start with this. Get the popcorn ready, because on Wednesday, the CEOs of the biggest banks in America are heading to Capitol Hill to testify before the House Financial Services Committee. The rundown is Jamie Dimon from J.P. Morgan, Michael Corbat from Citi, David Solomon from Goldman Sachs, Jim Gorman from Morgan Stanley, Brian Moynihan from Bank of America. We'll get to Wells Fargo in a second. Coincidentally, or maybe not coincidentally, Bank of America announcing today that the company is raising the minimum wage at its company to $20 an hour. And if nothing else, the timing of that announcement makes Wednesday probably a little less painful for Brian Moynihan testifying on Capitol Hill.
Yeah, I think so. I don't think there's much coincidence about it. I think it's we'll see. It seems like a smart political play at the moment, getting the headlines that they want and positioning, and they'll expound on that a bit in front of the cameras. So I think that it takes some of the wind out of the sails of those that are going to attack at least Bank of America, and I think everybody is going to be under pressure to respond. So, in terms of Wells Fargo, at the moment, if someone from Wells Fargo is on the list to testify, I haven't seen it yet. Doesn't mean it's not going to happen. We've still got time before the hearing, but I'm reminded of a conversation I had a couple of years back with Paul Leinert, who's covered the automotive industry for 30 plus years. And we have him on Motley Fool Money pretty much every year around the North American International Auto Show in January. And talking to Paul about the ripple effect of automaker X having some sort of large failure and failure to disclose the failure of whatever the technology is, whether it's Volkswagen and the emission standard, and just sort of the ripple effect. Like if you're any of the other automakers, you're like, oh God, because they all pay for it in some small way. And by the same token, Wells Fargo just continuing to screw up in terms of their own culture, the fake account scandal, Tim Sloan, who was there when the scandal happened, not being the right person to try and clean up the mess. And then, he is shown the door. If you're any of these other CEOs, I have to believe in the back of their mind, at some point tomorrow, they want to say, hey, at least we're not Wells Fargo. I mean, it's one of those things where, yes, it's a Wells Fargo problem, but it really does spread to the other banks. Yeah, I think that they'll probably, to the extent they can, sort of redirect the questioning toward, oh, well, Wells Fargo, you probably would have enjoyed having them here to kick around. And I was looking up some of the data on what's been paid so far post 0809, and there have been about a $250 billion in fines against the banks.
And not all that's cash. Some of that has been settled by loan forgiveness and some other credits. But it's in terms of there was a bailout of the banks, true enough, and they paid back the money that they were in some cases forced to borrow from the federal government, but that was paid back, and they have paid fines. And I don't know that it is a strong thing to say, hey, look, we've already paid $250 billion, combined in fines, so don't act like we haven't already been punished. That's not going to get them anywhere. But they can talk obliquely, I guess, about having made amends at times.
Well, and one difference between now and 5 years ago, 8 years ago, that sort of thing, is you can make a pretty strong case that big banks are no longer number one on Capitol Hill's enemy list in terms of the business world. I think that big tech has probably supplanted them. So for any CEO who wants to trot out there, well, hey, at least we're not Wells Fargo, they could just as easily say, and by the way, we're also not Facebook.
Yeah. Well, and I don't know that that's going to go anywhere either. So they've got to accentuate the positive part of the story in this $20 minimum pay, which Monahan has said, look, anybody who works here is going to be making at least $41,000 a year. That sounds pretty good. If you're thinking in terms of a minimum wage job, of which there are essentially none in a bank, right? You've got bank tellers to the degree that that's a major part of the employment of banks. I don't know how much that's the case, but you don't have a lot of employees who are probably, competing with at any of these banks who are thinking of what are the other minimum wage jobs that I would be comparing this against. But I think it is a positive, and they're pointing to it in part as something that they are doing. They're connecting the dots between the tax cut and making this, sort of passing on some of the profits that they are sitting on from the massive tax cut. So that will get them some of the way with maybe about, one half of the aisle, one side of the aisle will allow them to talk about that, and the other half probably less so.
Like I said, get the popcorn ready. Let's move on to Cerner Corp, which is a healthcare technology firm. Cerner has reached an agreement with Starboard Value, well-known activist investors, to add 4 members to the board of directors. Cerner is also buying back $1.2 billion worth of stock. Which of these two things is pushing shares of Cerner up 10% today? Because my assumption is, just based on the fact that shares of Cerner have sort of treaded water over the last 5 years or so, I'm assuming it's the board seats.
I think, swimming along in the line that Starboard is recommending. It's remarkable. Starboard really doesn't have that much of Cerner. I think I read about 1% of Cerner stock, but there's a whole laundry list of changes that are going to be made, including the strategic business unit being eliminated. I think that the dividend was just recently just started by Cerner, and it looks like they are going to be forced to change some of their capital allocation, including at least an authorization to buy back up to $1.2 billion. Whether that gets followed through or not, we'll see. But I think the board seats is, that's all part of the equation. I don't know how you can separate a 12% move when it opened, and now it's maybe 8 or 9%, and what part of that is ascribed to what part of this whole package.
I'm not looking to knock Starboard Value, but I am curious about something that you just said, which is that Starboard Value only has a 1% of Cerner stock. How are they getting 4 seats on the board if they only have 1% of the stock? This seems like something you get when you have at least 5% of the stock and really closer to 10% of the stock.
I agree. I was surprised when I read that, and so I want to admit that I need to make sure that that's the case before going too far. But if it is the case, you can guess that they have some other shares that they are in communication with that are on their side. Because 1% is 1%. If that's all that it means, is hey. Sell your 1% if you don't. If you're that unhappy. I mean, we don't. You don't have as much power as you think. But if they have plenty of people on their Rolodex and know where to push the buttons and organize the votes at that proxy time, then that's a different story.
Yeah, I was going to say, if in fact it's only 1%, then that opens up a whole world of opportunity for activist investors potentially. Our email address is marketfoolery@fool.com. Question from Deng, who is writing from China. Deng writes, I've been listening to Market Foolery since I started investing in stocks in 2014. Lately, I've been looking at some large cap stocks which may not grow that fast, and cites as examples Kroger, General Motors, and some airline stocks. It goes on to write, I'm considering their PE values, which are below 10, making them cheaper than the market average. Are they a bargain or are they potential traps? Oh, the age-old question, Dang. Value play or value trap? Because that is always the thing that sucks in, I was going to say value investors, but really a lot of investors. Just, there are growth investors who just see a stock get knocked down 20% in one day and immediately start thinking, well, look, it's on sale 20%. So, maybe I should be jumping in here. How do you help people think about solving this question? Because we're talking about more than one stock here. And we're not going to go through Kroger, General, we're not going to go through all of them, but what do you sort of look for once you've made that initial calculation of, okay, here's a large cap. It's not going away. And sometimes we're looking at large companies that are paying a dividend. So there's some reason to buy them. Maybe this business isn't setting the world on fire, but you've done the math and you say, well, look, from a PE standpoint, this is significantly cheaper than the overall market. Why shouldn't I buy a few shares?
Yeah, it is a good question. And to take the PE, so it's I'm looking at data that right now in comparison to its forward earnings, GE, for instance, is at 5.8 times forward earnings. And boy, that sounds cheap.
That is cheap.
Over the last 5 years, the average is 6.2. It's usually
for the market?
For the last 5 years for GE.
Oh, for GE.
So GE is not, it's maybe, 5% cheaper than its 5-year average in comparison to the forward earnings expectations. And why is it so cheap? One, the forward earnings tend to be overly optimistic, not only for GE, but for everybody. At this time of the year, you've only got one quarter not even yet reported, and so there is the typical enthusiasm about the year ahead, and as the year goes down and companies report and they say, we're not going to earn quite as much as we maybe thought we did or as you thought we did. Additionally, it's a highly cyclical industry, autos, and auto sales have begun to level and decline, and that is the way cycles work. And so you're looking at pretty good rear view earnings for GE. And, it's just that highly cyclical stocks don't carry big multiples, because when they have good earnings, it seems like, now it seems really cheap. And I can go back to 2016 and find that the company was trading at 4 times earnings. And, then it was over after last year, had a little bit of a decline. Wait,
is this GE or General Motors?
Sorry, General Moters.
Okay.
Have I been saying GE all this time?
Yeah, you've been saying GE this whole time.
Well, it's pretty cyclical too. But, no,
I was like,
General
how is
Motors.
GE?
GM, General Moters. Can we just filter all that out? Is there some sort of AI programming that can solve all of my misstatements?
If there was an AI program, believe me, the AI program
would be sitting in that chair right now. We'll put a little note in the description of the podcast, and hopefully people will read that. That makes a lot more sense to me that that you've been talking about General Motors this whole time.
It makes sense that I would be misstating things for minutes.
Yeah.
And Kroger is fairly similar. The major grocers, they're not growing very much. In fact, they're under some increased pressure from Amazon/Whole Foods. And so they're not really expected to sort of compound earnings particularly. People aren't going to be eating more next year than they are this year. So you're really looking at sort of population growth as the driver of what they can do other than acquiring other grocery chains. And that doesn't look like the greatest use of capital at the moment either. So Kroger is trading at, one of the multiples is trading at 0.16 times sales. Of course, there's very, very, very low margins for grocers, and that is quite a bit less than the 5-year average of 0.26. So, on a valuation basis, I'm a little bit more attracted by that, but I'm not really so attracted at what the next 5 years looks like for Kroger.
Well, I think it's a great point that, again, the question is, I'm looking at these stocks and their PE relative to the market. And I think the point you made at the beginning before you started confusing GE and GM was, hey, don't just look at that. I mean, that's a good point of comparison, but you also want to look at what is the PE of this stock relative to what it has been. Compare the valuation to itself. Because as you said, in the case of General Motors, yes, it's cheap relative to the market, but relative to what it has been over the last couple of years, it's not like it's trading at some amazing discount to what it has been.
Yeah, you want to compare it to its own history and to its sector, to its closest competitors. And, in that case, you normally learn fairly quickly whether there's something company specific or whether it's a broader application to, the industry. Ford right now is trading at 7 times earnings. So a little bit more expensive, but not meaningfully so.
Speaking of large caps, there's a story from last week that we did not get to about Kellogg. Kellogg is getting out of the cookie business so it can focus on breakfast cereal and snacks. Kellogg is selling its Keebler cookie brands and Famous Amos to Ferrero for $1.3 billion. Ferrero, the parent company of Nutella and Tic Tacs, two tasty things that don't necessarily taste great together. But this seems like a good move for Kellogg because you look at the cookie brands that they had, they were doing less than $1 billion in sales and driving not a lot of money in terms of operating profit. So it seems like even though the breakfast cereal industry has its challenges, this seems like I think if I'm a Kellogg shareholder, I'm generally happy about this move.
Yeah, I mean, I don't know how much it was distracting them from focusing on cereals. If it was, then it's a good move to get rid of it. It doesn't seem like, Keebler cookies, it kind of runs on its own. I mean, you get some synergies from just taking up more shelf space in the grocery store. So that allows you some economies of scale, but, maybe it wasn't in this case. Maybe the cookies were being, the logistics of getting the cookies into the same place that the breakfast cereals were going was not achieving any economies of scale. I don't know. I think that, consumers won't notice any difference. Ultimately.
No, they definitely won't. I think that, and look, Kellogg's been trying to sell these for at least since the end of last year. So this was something that they were able to execute. Maybe they didn't get the price that they wanted, but they were clearly looking to streamline, and good for them.
Because, like you said, consumers aren't going to be able to tell the difference. And I'm sure on some, like for all of the jokes I make at the expense of Mondelez, I mean, they're really crushing it in the cookie business. And so I'm sure part of the thesis for Kellogg was like, look, we don't need to keep doing this.
We can't compete with 70 flavors of Oreos.
We can't, and we're not going to anymore. We're going to let that be someone else's problems. Now, we'd like to introduce you to 70 flavors of Pop-Tarts. Let's talk about that. And that's working for Kellogg.
Yeah, I think that there are quite a few flavors of Pop-Tarts popping up, but they're not quite as trendy as the Oreos.
I don't know.
I mean, they don't have like the flavor of the day kind of thing that Oreo seems to.
They don't. And the Oreos with the thing about Oreos that has not broken through for Pop-Tarts is the brand marketing alliances that you see. So the most recent one for Oreos is the Game of Thrones inspired Oreo cookies, with the final season of Game of Thrones getting ready to start. And it's like, okay, I guarantee you the HBO marketing people were not going to Kellogg saying, look, we have an idea. It's a Game of Thrones breakfast cereal or Game of Thrones Pop-Tarts. No, that's an easy one. That's a layup.
Who would not want dragon-flavored Oreos?
What does that taste like? I think they're just going like straight up chocolate. I think they're like baked.
What's that got to do with Game of Thrones?
I don't know.
It's like they haven't been watching the show at all.
I don't think these are dragon flavored.
Well, that's just a missed opportunity. You would have thought Oreos would have been on top of that one.
Well, there's a Game of Thrones fan in my house, so I think I'm going to have to pick up a box of one of these things. For all of my railing against Mondelez, I'm actually going to be contributing to it.
You're going to fall for it, huh?
Well, I mean, if I can momentarily buy one of my kids' love, just for a few bucks, yeah, sure, I'll do that. I have no problem doing that. Don't tell me you haven't done that before. Most parents have done that.
Oh, yeah.
Oh, here's a little thing. I'll spend a couple of bucks. My kid will be happy. No, that'll be that.
Yeah, I mean, it's just Oreos. I mean, how?
Right.
It's not wasted money.
Right. They're going to get eaten. Might as well benefit from it. Mm-hmm. You can read more from Bill Barker and his colleagues. Maybe in the next issue of Declarations, their free monthly newsletter at MFAM Funds, maybe they're going to write about GE. Maybe they're going to write about GM. Maybe both. There's only one way to find out, people. Go to mfamfunds.com and sign up for Declarations. It's free, for crying out loud. And it's good, too. It's really good content from Bill Barker and the MFAM Funds team. So check it out. Thanks for being here.
Thank you.
As always, people on the program may have interest in the stocks they talk about, and the Motley Fool may have formal recommendations for or against. So don't buy or sell stocks based solely on what you hear. That's going to do it for this edition of MarketFoolery. The show is mixed by Dan Boyd. I'm Chris Hill. Thanks for listening, and we'll see you tomorrow.